Yes, I see it's a glorious time, the end of the month, and we have a lot of bills.
Sure do, Peter.
And we seem to be a little short of money again.
What else is new?
Why does it happen?
I don't think I know, but it just goes on and on.
Well, I'm Peter Silverman, and I'm the business specialist for City Television. And there's a number of ways Chess, my wife, and I could cut back on cat food, or not give them so much milk, cut back on dog food. But that's not really the answer. Like most experts, I was long on giving advice and a little short of taking my own. But after going through a few months of being on the borderline of financial disaster with all the bills coming in, and not really knowing where the money was going out, we decided, my wife and I, to work at a home budget. And you know what? It works. And what I want to do is to show you how, along with some other financial techniques, to help you survive in these very rough economic times when every cent counts. It has helped my wife and I to get by, but it's not easy working your way through the financial rose garden. There's a lot of thorns in the way. But it does pay off. And not only that, I didn't have to cut back on my pet's food.
Look at it this way. If your combined income was, say, $2,000 a month, that's $24,000 a year. After 20 years, you would have almost $500,000. That's a lot of cash.
You know, if we were left to $500,000 or we had won it in a lottery, we'd think very hard and very carefully how we were going to manage that amount of money. But we don't give that same care and attention to managing money when we earn it.
That's a reason to try budgeting. Now, how to do it? A few things to keep in mind before you start the exercise. Consider your own situation. Will you be earning more or less? If you are a two-income family, will both be working for most of the years ahead? If not, can you manage on one salary? And how about things like mortgages? How much money will that take if it's up for renewal? And kids. Spending patterns change dramatically when that baby arrives. First, the mother might not go back to work for a while. Second, kids are consumers, big consumers. My wife and I found that out. Just to give you some indication, by the time they get through high school, your child will have cost you about $250,000. And kids sometimes mean a bigger house, and that's more money. Sounds a bit scary? Not really. It's surprising how we do manage. But a little forward planning can help ease the financial passage. Where to start? A good place is your family's income. Remember, not the gross income, the net after taxes. It's no use saying I make $25,000 a year when the government takes 20 or 30% of it. Always keep in mind that you're paying for your mortgage and for everything else in after-tax dollars. That's why I advise people who are, for example, about to buy a home to think hard about their future earnings and to calculate their ratio of property taxes, interest and principal payment, and after-tax income, not gross income. Okay, here's an example of how the calculation should work. Make sure you don't leave anything out. For example, any bonuses or commissions. Government family allowance, its income, and private business from freelancing, or some income from selling an item, for example, a car. And you might be renting a room to a student. Count that income in as well. A few definitions: dividend and interest. For example, interest on Canada savings bonds are part of income. In addition, you should also put together a yearly net worth statement. It doesn't help pay the bills, but it will indicate if you're getting ahead of the game or falling behind. It is also handy when talking to your friendly bank manager about a loan, or deciding if you can finally call it quits and go fishing, or even cash in some asset to buy what you've always wanted, that Porsche or a boat. A rule of thumb, you should be increasing your net worth by 2% a year after taking out the inflationary kick. Don't miss anything. That includes your wife's jewelry, and yours too. The value of your house. Any stocks or bonds stashed away, including any that are held for the kids. And those antiques could be worth something. Count them in, as well as collectibles like lead soldiers. They're worth a lot now. Some hints. Those old '78 records might be worth a fair bit now. Fiesta ware, that kitchen table pottery of the '40s. The Americans are collecting this stuff, so before you write something off or throw it out, stop, look, and listen. Having done all that, it's time to move on to what I call the planning payout worksheet. Those fixed and irregular expenses that occur over the year or for which money needs to be saved. As we go through this exercise, one fact becomes evident. Keep track of what went out, to whom, and when. Make sure you get it all, like those sometimes forgotten once-a-year insurance payments, the water tax, and things like the kids' school extras. Often it's $5 for a field trip, and it's forgotten in the activities of scrambling to get out in the morning. It's that sort of expense that can dime and dollar your income to death. Home budgeting is not something to be left for next month or next time. It should be done now. You will be surprised at the light it sheds on where the money is going. And to increase that light, try this. It's a sort of game. Statisticians call it the Pareto chart, and it works like this. Let's say that your net income is $2,100 a month and your total expenses are $2,000. Now, you may know where the money is going, but not realize what is costing the most. That's where the Pareto chart comes in. An example looks like this. After doing this for a few months, you will get a good graphic indication of where the cash is going. Let's say the greatest or one of the largest expenses is on food. You can do a Pareto chart for that, breaking down your food purchases by types of items. Who knows, you may find that you're spending an awful lot on needless junk foods. Some expenses are fixed, like the mortgage, but having a look at what it's costing in terms of your net income might help to set your priorities, like paying down that mortgage as soon as you can. How much in taxes should you pay? That naturally depends on your taxable income. That income left over after you have taken all possible deductions for children, a spouse, other dependents, charitable donations, and so on. One thing that's worth keeping in mind, every province collects personal income tax. All, except Quebec, let the federal government do the collecting and then get it back from Ottawa. So when you're making out your tax form, keep in mind you're making it out for two levels of government. All this gets into that oft-used phrase, the marginal tax rate. Here's how that works. It's having to cope with two tax brackets.
Well, let's say that after all the deductions, you have a taxable income of $20,216. And if you live in Ontario, your taxes will be $5,469. But what about, let's say, $200 of additional tax income? That is taxed at the marginal tax rate of 37%. Put another way, it just means that Revenue Canada will take 37 cents of every dollar of that additional taxable income. That's why accountants will tell you every time, drop that marginal rate, beat it down.
That means lowering your taxable income, and that means knowing and taking advantage of every deduction you are entitled to. Finally, it's always good to remember that the law has stated many times that a person does not have to arrange his or her affairs in order to maximize taxes. On the contrary, you have every right, so long as it's legal, to maximize your income while minimizing your taxes. Most people seem to forget this nice rule. Tax officials from Revenue Canada will admit that most people overpay their taxes. Try not to. A whole array of mechanisms exist to make buying easy. the various forms of easy credit, from bank loans to credit cards, what we laughingly refer to as plastic money, or, as I call them, plastic loans, because that's exactly what you are doing when you use a credit card, borrowing money.
Credit cards. It all began in 1950 with Mr. Frank McNamara. He ran a small loan company in New York City, and he offered select customers of 22 New York restaurants credit. That was the start of the Diners Club. He got his money by the restaurants paying him a commission for prompt payment of bills. Soon, in 1958, American Express issued their now famous green card. And in time, there were 18 million credit cards in circulation.
Needless to say, the banks were not going to let an idea like that slip by, but they had a different approach. To the banks, the money was to be made by collecting interest on unpaid accounts. In other words, it would be another way of offering consumer loans. The first bank to offer a credit card was the ill-fated Franklin Bank of Long Island, New York in 1951. Other banks followed. By the 1970s, Visa, MasterCard, along with cards sponsored by European banks, covered the world. In Canada alone, there are 12 million bank cards in circulation. The whole operation is possible because of the computer and electronic banking. For the banks, the interest rate varies between 18 to 24%. But if you plan carefully, using plastic money has its advantages. Let's take a not untypical situation. You badly want that hand power saw or weed eater or gardening supplies, but just haven't got the cash. Come payday, you'll manage it. But wouldn't it be nice to have it now, to get an interest-free loan for, say, a month or so? You can. It's right here with your plastic money. Here's what you do. First, look at a few of your bank credit card statements. You will see the statement date and the payment due date. Usually, the time between the two dates is 25 days. Now look at your records. You will soon be able to find the cutoff date for a purchase made in any particular month. For example, a purchase made on November the 10th could appear on the January statement. You will find that by adding up the days between the cutoff date, the statement date, and the payment due date, you could end up with a 60-day interest-free purchase loan. There's another factor to keep in mind as well, especially now that things are tough. Visa and MasterCard bill retailers a commission, which varies from 1/2 to 5 3/4%. Most small retailers will give you that discount if you offer cash. There are a few other facts that have to be considered. The first is that you must always check your monthly statement. If anything is wrong, you have to set it right. It's a good idea to always keep your customer's copy of the merchant's bill and compare it with your statement. Sometimes the bank's computers get it wrong. The figures are not correct. Second, keep up with your payments, or better still, take advantage of the 60 days of interest-free credit, but pay up. The reason? If your bank credit card is from the same bank as your regular accounts, the bank credit card holder has a legal right to take money out of your account to cover your credit card payment. So it's a good idea to split your accounts between banks, or make sure the bank that issued the credit card does not hold your major accounts. Remember, the interest on a cash advance on your Visa or MasterCard begins the moment you receive the money. If you have to borrow, don't do it that way. It's too expensive. Finally, the banks are beginning to charge every time you use a credit card. Now, the Royal Bank will charge each of its 5 million Visa card holders 15 cents each time they use its card. The card holder does have the option of paying a fee of $12 annually, but unless a card holder uses a card 80 times a year or over 7 times a month, it's not worth paying the $12.
Now the proverbial other side of the spending coin, savings, and where should you put your savings? Well, the first financial institutions that come to mind are the banks, particularly the Big Five. And they're the Toronto Dominion, the Bank of Montreal, the Bank of Nova Scotia, the Canadian Imperial Bank of Commerce, and the Royal Bank. Between them, they dominate the market. But there are 6 other chartered banks, smaller, And they're called charter because they derive their right to operate from a charter given to them by the federal government. And they operate under what is called the Bank Act. These 11 chartered banks operate approximately 7,000 branches across Canada, but with the advent of the computer and electronic banking, those automatic tellers, and the necessity to cut costs, some of the banks are beginning to cut back on some of their branches.
On top of that, there are the foreign banks operating in Canada. For example, the Bank of America, Citibank, the Chase. Don't completely disregard these banks. They sometimes offer slightly higher interest rates on savings and can be easier to get a business loan from. However, they aren't usually for the small saver or borrower. In addition, there are the trust companies and credit unions. For years, trust companies were the haven for the pompous pinstripe men who guarded the bonds and stocks that were given into their care for the support of widows and orphans. Well, as the ads say, they have come a long way. The trust companies operate somewhat like banks. They have branches with both savings and checking accounts. Investors can buy term deposits. That is money put in a savings account for a specific period of time, say 30 or 90 days. Customers could also buy guaranteed investment certificates, often called GICs. These are savings certificates with terms of 1 to 5 years with a fixed rate of interest. All this has created the appearance that trust companies are little different than banks, offering everything from personal loans to checking accounts. But a trust company does not have access to the Bank of Canada as a lender of last resort. In simpler terms, as a backup lender if the trust company runs out of cash. Banks must place money in deposit at the Bank of Canada to protect their depositors. This is called a reserve. A bank cannot lend out more than a certain percentage of its reserve. Not that the rules are that tough. Often a bank can lend out as much as $25 for every dollar it has in reserve at the Bank of Canada. Because trust companies do not have these reserve regulations, they must keep their own reserves and be more tightly regulated than the banks. As an example, trust companies are limited to the amount of money they can lend out for consumer loans or for speculative investments. One of the trust company's major investments, because they are so safe, are mortgages. Here again, the trust companies cannot lend out more than 75% of the appraised value of the property in mortgages. The trust companies live with these regulations as they do not have to put large sums of money in the Bank of Canada as reserves, where it does not get interest. All this means is that the trust companies can offer slightly better interest rates than banks. Trust companies can also act as investment counselors. It's not recommended to use them as such. Trust companies don't have a good investment track record, though there are exceptions. Much of the trust company's business is administering estates and often acting as the executor of estates, that is, handling all the paperwork and accounting for an individual's possessions after death, including paying taxes that are due. They also act as administrators for mutual funds, pension funds, registered retirement savings plans, and registered home ownership savings plans funds. There is one other type of financial institution that does many of the functions of a bank, credit unions. These are financial cooperatives where shares are sold to members. These institutions started out in Germany about the middle of the 19th century and gradually spread. Through the pooling of savings in a credit union, members are able to borrow sums of money, usually at rates a bit lower than from a bank. The original capital for the credit union comes from selling shares to its members, and to this are added the deposits of the shareholders. Each member has one vote in the election of officers and in the determination of the credit union's policy.
All of these institutions have one thing in common. They're out to make money and use your money to do it. So it's your job to shorten the money odds. And the best way to do that is to learn the rules of the game. And the first rule to remember is that money is just like any other commodity that's bought, sold, or loaned. Instead of selling mousetraps, banks sell or loan money. Banks make their money on what is known as a spread. That is the difference in the rate of interest they pay on money they borrow, for example, from you when you put it into a savings or checking account, and the rate of interest they get when they loan money out, for example, for a personal loan. Your object is to maximize your savings investment to get the best rate of interest from that. Now, there's all sorts of ways to save, what is known as savings instruments. For example, savings accounts, guaranteed investment certificates, or term deposits. And all a term deposit is when you put your money into a financial institution to save it for a specific period of time, let's say 30 days or 90 days.
There are various reasons to save, but let's face it, it's far more fun to spend than to save. But to make saving a little easier, have an objective, have a reason. Here's 2 or 3. Saving for a rainy day, for those expenses that are unexpected. A second reason to save is for a planned expenditure, that holiday in the Bahamas or a home computer. This means stashing away money for a definite period of time. Then there is long-term saving. This is more for providing an investment or retirement income or an improvement in your overall security. A few rules of thumb. Rainy day money should not be put into a savings account because it's just too easy to get at and spend, and the interest rate is usually lower. Put it into something like a Canada savings bond or a term deposit, making sure that you can get at it when you need it. Saving for a planned expenditure gives you a bit more flexibility, provided it is for less than a year. You should use a savings account simply because you can draw out the money and put it in at any time. And finally, there is long-term saving. Here you should look at every possibility, including RRSPs to RHOSPs. The key to saving is to make sure that all your money is working for you, and that means understanding the magic of compounding.
For example, if Samuel de Champlain had deposited $1 when he arrived in Canada in 1608 at 8% monthly compounded interest, he would have $900 billion today. That's what compounding does to savings.
With compounding, every $100 you save is worth the effort. At 12% compound interest, $100 becomes $220 by year 7, $309 in year 10, and $434 in year 13.
It's how the interest is calculated. That's the important thing to remember. For example, if Mr. Champlain had deposited his dollar when he arrived in Canada at simple interest, he would have ended up with $29.76. That's because he would have received a measly 8 cents on that dollar every year for 400 years.
Let's look at a couple of savings accounts. The first is where the interest is paid on the minimum balance at the end of every 6 months. Let's do some calculations. $10,000 invested at an annual rate of 12% will earn $1,200 interest after the first year. But what happens if it's invested at 12% compounded semi-annually or every 6 months? The column on the left shows how the interest builds up. The column on the right shows a buildup of principal and interest. Note, at the end of the first year, you've earned $36 more interest, and after the end of 5 years, $360. But beware, the interest is calculated on the minimum balance over a 6-month period. If your account is down to $1 for 1 day during those 6 months, the interest you will receive will be 12 cents. Now let's compare that with an account where the interest is calculated on a daily balance. Just remember, the banks, like any other business, are not in the business to give away money. So you might find that the interest they pay on your daily average account is about 3/4 to 1% less than they would pay on a normal savings account. And also, they might ask that you have a minimum monthly balance before you get any interest at all. And sometimes you do not get checking privileges with a daily average account. So you could end up paying more in service charges than you get back in the additional interest. The secret here is to make sure that you know the various savings accounts that are available. If you are using a daily interest account, make sure that your payment transfers are done at the end of the month. And it's sometimes possible that the banks will allow a certain amount of checks to be drawn on a savings account. So with some careful planning, you might be able to get both better interest along with limited checking. As I suggested before, keep as little as possible in your checking account and put that money in a checking savings account where you will at least gain some interest. Check into 30, 60, or 90-day term deposits. They pay slightly more than savings accounts. If you do not need your money for a longer period of time, then you might consider one-year certificates, which often have a better yield. It is important when considering ways of saving to start thinking of your money in terms of before and after tax value. For example, if you have a Canada savings bond worth $1,000, paying 12% interest, then your before tax income is $120. However, if you have used up your $1,000 tax deduction for dividend returns and your marginal tax rate is, say, 35%, then your after-tax or real return is only $78. That is $120 minus 35% of the $120. Borrowing money. No one likes to do it, and we all do it most often and most simply by using a credit card. However, when you borrow, you are paying it back in after-tax dollars. Example, if you borrow $1,000 at 14%, you would be paying $140 in interest. If your marginal tax rate is 37%, then in order to pay the $140 in interest, you have to earn $222. The calculation? Subtract your marginal tax rate from 100. That gives you 63%. Divide $140 by 0.63. That gives you $222. The reason is that you only have 63 cents out of every dollar to pay back the loan after taxes. However, when you borrow money, here are a few things you should keep in mind. Interest rates generally move with the prime rate. That is, the rate the banks charge their best and most secure customers. Know the type of loan you want. Here are some you can get. The first, a consumer loan. The interest rate is usually several points above the prime. The reason, the greater risk. The cost of life insurance is included. The advantages of a consumer loan is flexible prepayment without penalty, and you usually can get it fairly quickly. Remember, a consumer loan is generally a term loan, that is, for a specific period of time, for example, 36 months, at a fixed rate of interest. If interest rates go up, the bank cannot raise these rates. If interest rates go down, you can renegotiate your loan, generally without penalty, though some banks might charge a small administrative fee. The bank might also run a new credit check on you. If your financial circumstances have changed for the worse, the bank might demand higher payments and you might not get the lowest interest rate. A demand loan. It's also a personal loan, but interest rates are generally lower than a consumer loan. You must have some collateral. The interest rate is usually the prime or just above. The disadvantage is that the bank can call this loan in at any time. The interest rate on a demand loan goes up and down with the prime rate. This is good if interest rates are falling, not so good if interest rates are going up. If your loan is well secured, you can sometimes arrange with the bank to only pay the interest charges. This might be useful if you need to use your capital for other purposes. Some good news, under the new Bank Act, consumer loans will be calculated on the basis of simple interest. That means paying less interest charges. It won't all be deducted at the front end of the loan, and you will be paying off the loan and the interest at the same time. In other words, paying interest on a declining amount of principal. Other types of loans are cash advances on a credit card, finance companies, department store credit. All these charge much higher interest rates for their services and should be avoided if at all possible. Always avoid a bank overdraft. There are service charges besides the high interest rates. And if you are going to use your credit card for a loan, remember the rules we've discussed before. One of the cheapest loans around is borrowing against the cash surrender value of your insurance policy. The amount of your insurance is lowered until your loan is paid, but the terms are very flexible and the rates the best you can obtain.
Just remember that bank managers have a certain amount of leeway as to what interest rate they will charge you. And when you go in to negotiate your loan, have a pretty comprehensive list of your finances, your assets and your liabilities. Hint to the manager that if he treats you nicely, or she treats you nicely, that you will in fact do more business with that bank. And finally, make sure that the bank official tells you the terms of the loan and its cost.
Finally, remember the cost of the paperwork to get your loan. You do not have to deal with the bank you have your money in. In fact, it's worthwhile looking at loans from trust companies or credit unions if you can join one. Sometimes their rates are slightly lower.
Show me what it's going to cost.
Here's an example to underline what we've been saying and to show you one of the pitfalls of listening to eager salespeople. Let's pretend that you want to buy that new car, but you need $10,000 to do it. Let's say you have the $10,000 in the bank. Should you pay cash for the car or finance it? Your salesperson will tell you about the new low financing available at 12.9% and will emphasize that it is simple interest. The interest that you will pay over the 3-year period of the loan will be $2,112. The payments, $336 a month for 36 months. The salesperson will point out that leaving your $10,000 in a monthly savings account at 12.9% will earn $4,695 in interest. So the salesperson will say, finance with us, and you will come out ahead, the difference between the two amounts of interest. In effect, it will be an interest-free loan. So here's what the car salesperson's calculations look like. Interest on $10,000 at 12.9% compounded monthly, $4,695. See, the salesperson will say, you're $2,583 ahead. It's like having an interest-free loan. Wink, wink. Looks mighty good, but what would happen if you paid cash for the car and each month saved the same amount you would have spent paying off the car? That's $336.46 a month for 36 months at 12.9% compounded monthly. At the end of 36 months, you have $14,853, of which $2,741 is interest. Now let's see how it all looks. First, the interest saved by not financing the car is $2,112. Secondly, the interest gained by saving that $336 a month for 36 months. That's $2,741. Then, third, the additional capital saved, $2,102. That makes a grand total of $6,965. Subtract from that the interest you lost on your $10,000 over 36 months by using that amount to pay cash for your car. And what you come up with is your net gain of $2,270. Beware, when a car dealer offers you low interest rates, he will try very hard to sell you such extras as paint protection or upholstery Scotch guarding. These are very high profit items, and it's a way the dealer covers some of his cost of offering below normal interest rates. Here is a summary of things to keep in mind. 1, draw up your personal living budget. 2, see how much money you have left over and what it is to be spent on. 3, Keep a running check on your credit cards. 4, don't rush to pay off your bills. Put the equivalent amount of money in an interest-bearing account for, say, 30 days. Pocket the interest, then pay off your bill. Post-dated checks are one way of doing this. Make sure that your net worth should increase each year at least at the rate of inflation. 5, calculate the after-tax return on your savings and investments, deduct the rate of inflation, and try to end up with a net real rate of return of 2% or better. And above all, be flexible. The name of the game is to give you a better idea of where the money is going so that you can enjoy it even more than you are now. Want to play the stock market? Here's a few hints, homilies, and some basic information. First, what are shares? They are the means by which you can own part of the company. In more precise terms, you get to own part of the capital stock of the corporation. Example, if there are 100,000 shares issued and you own 10% of them, you own 1% of the company, are entitled to 1% of the issued dividends, and have 1% of the votes on choosing a board of directors, for example, at annual shareholders or other meetings, and 1% of the company's assets, if it is wound up. A dividend, by the way, is money paid out to shareholders out of the company's profits. In Canada, it is usual that 1/2 of the profits are distributed and half retained for reinvestment. Incidentally, there are classes of shares. The two main ones are preferred and non-preferred. Preferred shares get paid a set dividend and have first claim if the company is wound up. They also get first claim on any profits. Common shares take their chances. Incidentally, preferred shares have a par or face value printed on the share certificate. The dividend is calculated as a percent of the face value. This means that if the face value is $100 and the dividend is 10%, then every year you will receive $10. On the other hand, and there is always the other hand, the market value of the preferred share might well be higher or lower than its face value. Why? Well, if the dividend payout is 10% and the prevailing interest rates fall below 10%, the value of the preferred share will go up. Overall, the value of a share is determined, as is the value of anything that is bought and sold, by supply and demand. If there is a demand, the price goes up. If people don't want to buy shares in a particular company, the price drops. If the company is making good profits and distributing high dividends, then the share value will rise. If the company is losing money or not doing well, or there are doubts about its management, the price will drop. These naturally are general rules, and like all rules, there are exceptions. How do you buy shares? At a few central locations called stock exchanges, for example, the Toronto Stock Exchange. And how does it work? Fairly simply. It's like a fast-moving auction. Organized confusion as traders, the people who do the buying and selling on the floor, dash about executing orders phoned in the brokerage houses.
It all looks completely incomprehensible, but imagine that they're not dealing in shares, they're dealing in heads of lettuce. Simply put, let's assume there's only so many heads of lettuce around and so many buyers and sellers. If more people want to buy heads of lettuce, then the price will obviously go up. If more people want to sell, then the price will go down. And that's exactly the same with shares. You've got to have buyers, you've got to have sellers. If there are more buyers and sellers, the price will start going up. If there are more sellers than buyers, the price is likely to go down.
Now, how about that guy, the broker? First, how to find one. Ask a friend, someone at work. Enough people do invest in the market so that discovering someone who can give a suggestion should not be too hard. Or simply look in the yellow pages and pick out a broker that's a member of the major stock exchanges. But size is no guarantee of expertise. I know several small brokers who do very well. They buy and sell by arrangement with a bigger house, but being a lean and hungry and small, they offer better service and perhaps advice, while a big firm is geared to the big player. Overall, pick the broker or investment planner by the person, not by the company. It's also a good idea to meet he or she in person. Remember, the relationship is based on trust. Another hint, Every year, the Financial Post and other publications turn out a list of the brokerage houses with the best analysts, the people who keep track of certain sectors of the economy, for example, like gas and oil, forest products, or chemicals. If you are interested in investing in one of those, then it might be worthwhile dealing with that brokerage house. Now, having found yourself a broker, you simply call, say you are interested in becoming a client, and you will be put in touch with a salesperson. He or she will fill out all the required forms, and you will sign them. After that, you will be able to conduct your buys and sells over the phone. So here we go. But wait. You will need some basic information to begin with. No one bets a horse without knowing the odds, a bit about the nag's track record, and perhaps how good the jockey is, the track conditions, the basic stuff. Same with buying stocks. Get the information first. After all, you are betting that the shares you buy will be winners. One place to begin is with your daily newspaper. The business section contains a summary of the day's trading of major stocks on the various exchanges. When you look at the information, it will generally look like this. Let's start with the basics. The third column is the name of the company whose stocks are being bought and sold. The first two columns show that over the past 12 months, Widget's share values have gone as high as $20 a share to a low of $10 a share. That can give you an idea of the possible range in value of the stock, how high or low it might go. Stocks usually go up or down a minimum of 1/8 of a dollar. So quotes are, for example, 6 5/8 or 7 1/4 or 8 1/2, and so on. Price movements in lower price stocks are in steps of 1/16 or 1/32 of a dollar. Volume indicates how many shares were traded that day. If you have been keeping a record, you might find out that a lot more than usual are being traded. That could indicate that something is happening, good or bad. For example, a rumor of a takeover bid, or a rumor that the company isn't doing so well, or that it is coming out with a new product, or that there are hints that its profits are way up or way down. Next, the price-earnings ratio. That is simply the earnings for each share, the dividend compared to the market value of the stock. For example, if the stock is traded at $20 and the dividend or earnings are $2, the dividend yield is 2 divided by 20, or 10%. But the price-earnings ratio is 20 divided by 2, or 10. As a rule of thumb, the lower the ratio, the better the stock. But don't take this as written in stone. Some companies simply go along in the same conservative way, with the same price-earnings ratio, but their share value also remains stable. Why? Because the experts know that the company isn't going to set any worlds on fire, that its chance for growth is slight, and its management unable or unwilling to be aggressive. On the other hand, there are companies with a very high price-earnings ratio who are seen as aggressive. Perhaps their dividend is low because money is being used for expansion on new plant or equipment, which could translate into higher profits in the future. So the investor has to ask some questions. Taking this into account, here's a list of questions to ask yourself or your broker. Are the dividends high because little money is being put back into the company to ensure future growth, competition, or even survival? Second, how secure is a dividend, and will it go up in the future? Third, what's the management like? A good broker should be able to have some insight as to the management of a company. If he can't answer that question, if he seems unsure about the company's track record beyond simple charts or graphs, find another broker. Okay, now for the last three columns. They show that during the day the stock traded for a high of 8 1/2 and a low of 6 1/2, and that the last trade was at 7 1/2, showing that the shares rallied to move back up again. The final column shows a difference between yesterday's closing price and today's. So yesterday's closing price was 9 1/2. Now, how to place an order with your broker? Simply phone and say buy or sell so many shares of Widget at a specific price. If you do not set the price, then the broker will buy the shares for you at the market. That is, the value of the shares at the time your order to purchase reaches the floor of the stock exchange. It is always a good policy to tell your broker at what price you want to buy or sell a stock. It is also a good idea to keep a log of all your transactions, the date, the time, price paid or sold for, and profit loss. And remember, the broker takes his commission from the buy-sell transaction, and he takes it from you. That's where he makes his money. A hint, Say you wish to hold on to the shares for a long period of time. Then ask a broker to get the share certificates sent to you in your name. That means it's tough for anyone else to try and cash them. Most share certificates are in the street name, that is, not signed, and can be easily bought or sold by anyone. After a lot of sacrifice, you finally got your home, or you've owned your home for some time. Then interest and mortgage rates began to rocket through the roof, and the renewal date was fast approaching. We all learned a lot about interest rates and different types of mortgages. We also learned that the comfort of owning a home was very fragile. The lesson, pay off the mortgage before you pay off anything else.
Take a typical mortgage. Usually it's amortized or paid off over 25 years. That means that the total interest is based on the fact that you're borrowing the money for a quarter of a century. Monthly payments are designed to chip away at the mortgage charges and the principal. But as the period of borrowing is so long, you're paying far more of the interest at first than you are of the principal. Now, I've done a few calculations here based on a mortgage of $60,000 and interest rates of 12%.
Amortized over 25 years, you will pay $125,670 in interest. The monthly payment, $619, principal and interest. Cut that amortization time by 5 years and you will save $30,096 in interest, and your monthly payment is $648. Pay down the mortgage by $5,000, and that cuts the amortization by almost 8 years and your payments by almost $60,000. So, save a bit and get rid of some of that mortgage. One hint, when you renew, check the bonus or penalties for paying down or altering your mortgage. Or better still, try and get an open mortgage, which allows you to pay off any or part of it without penalty. Always make sure that the penalties are written into your mortgage. Don't rely on your lawyer saying that a 3-month penalty is standard. It isn't. One last thing to watch for. Some mortgage lending institutions are no longer allowing the mortgagees to pay down part of the principal on each anniversary of the mortgage.